Hello, hi, I'm Nick Burgess. I'm a quant analyst. I work in financial services and I specialize in electronic rates trading. Now, today I'm going to talk to you about yield curve modeling, and I'm going to take you through a slideshow I prepared today for you in PowerPoint. And without further ado, let's jump in. Give me 1 second. I'm going to share this screen. There we go. Now, so we're going to talk through yield curve modeling and what that is and why it's important. So what I'm showing you here is the ICVS screen in Bloomberg. That's the interest rate curve page, and I'm going to tell you So let's talk about what this is and what is a yield curve. So this is the yield curve page in Bloomberg. It's for a US dollar SOFR curve, and what exactly is that? So yield curves, they're a collection of forward rates and discount factors that we need for pricing interest rate products, and discount factors in particular are very important for all products. So discount factors, what they do is they're like a scaling factor. And if you want to sort of evaluate what the present value is of a cash flow that's in the future, you multiply your cash flow by the discount factor, and that will convert a cash flow in the future to today's present value. And that's really important for pricing. Now, the other thing that you get from a yield curve is a collection of forward rates. And that's the market's sort of expectation of what interest rates will be in the future. And that's very useful for interest rate products for pricing. So a yield curve is basically a collection of forward rate and discount factors that are needed for pricing interest rate products and discount factors in particular for quite a lot of, if not all, products in the market. Now, the way that we build a yield curve is that we take a collection of calibration liquid instruments in the market, and we know the prices of those instruments, and then we work backwards. We work out, well, what interest rates and what discount factors would we need to use to reprice these instruments. And so we take that information and we create a yield curve. And that's called the calibration process. Now, the instruments that we do typically use for interest rate yield curves would be cash deposit, which is what you see here, 1 day sort of cash deposit. We also have SOFR swaps, which is more for the long end of the curve. They're typically quoted with 1 year maturity, so 1 year, 2 year, 3 year, all the way out to, in this case, 50 years. And then at the very front, futures contracts, or in the middle section of the curve, the futures contracts are more liquid. And so we tend to prefer to use futures contracts instead of swaps in the midsection of the curve. And so I guess we're talking about the 1, 2, 3, the first 3 years worth, perhaps from 1 year to 3 year, we probably use futures in that section. You can use a lot more, of course. It's a subjective sort of process where you just pick what you think is the most liquid instruments. So cash deposit on the front, SOFR swaps on the end, and then in the middle we would use futures contracts. Now in the US market, there are 1 month and 3 month SOFR futures, and you can overlap them. That's fine, but you have to make a choice. I've picked sort of 3 month futures contracts here, and one thing to sort of bear in mind when you're using futures contracts is that we need to make convexity adjustments, and Bloomberg's going to do that for us. But if you're sort of setting up your own yield curves, you'll need an interest rate model such as the Helm-White one-factor or two-factor model to work out to derive those convexity adjustments. And what a convexity adjustment is the futures contractor mark to market as an instrument, and that marking to market sort of removes the curvature or the convexity from the futures contract, so the futures behave a lot more linear. And we want to put that back because interest rates and forward rates and discount factors typically don't have this mark-to-market feature, and so we have to put that back. And so the convexity adjustment is to add back convexity that the mark-to-market of futures positions would remove. That's the convexity adjustment, and there'll be a lot. We're not going to talk about that in great depth in this chat, but I will provide sort of reference material for further reading. Okay, so that's the overview of a yield curve. Now, in terms of quant infrastructure, if you're to build your own yield curves, what infrastructure do you need? Now, the main things that you're going to need, obviously, you need instruments. You're going to need the short-term interest rate futures and swap instruments are the main instruments that you're going to need. Now, I would recommend that you set up the instruments first before you set up your yield curve. And the reason for that is quite often in many big banks and hedge funds, you'll find that the quants will set up a yield curve independently of the instruments that they're using in their library. So what that means is they'll have a swap and a future inside their yield curve, perhaps a reduced form. And then they'll have another swap and future outside of the yield curve for pricing, and then you have to reconcile the two. And that creates a lot of mess. It potentially creates arbitrage opportunities as well when those two instruments aren't perfectly aligned. So rather than trying to sort of perfectly align something, why not use the same instrument? So I strongly recommend create your short-term interest rate futures instrument first, and then the swap instrument, set them up, and then use them directly in your curve calibration routine rather than creating an independent copy. So the first thing, set up your instruments. Now, the second thing, interpolation methods, they're very important for yield curve construction because we'll typically have about between sort of 20 and 30 calibration instruments, sometimes fewer, sometimes more, depending on the curve. And you can't know and we need to know the forward rate and the discount factor at every point in time on every day. And that's not possible with the number of instruments that we have, the number of liquid instruments in the market. And so what we do is that we use interpolation. So we solve for interpolation, we solve for node points. We pick points in the market that we're going to solve for the forwards and the discount factors. And those are typically going to be the maturity dates of your calibration instruments. And then we fill in the gaps using an interpolation method. And we have to be really careful to pick an interpolation method that matches the dynamics of the market. And so typically what we want an interpolation method that's monotonic, which means it's not going to have kinks or twists and turns between node points. It's going to be smooth. It's going to be arbitrage free, locally stable, which means if you bump an instrument point, you don't expect your curve to wildly change for a small change in one calibration point. And the reason why you want it locally stable is that you want it to give you a fair reflection of risk dynamics. And when you run risk scenarios where you sort of shock the curve, you want all of that to be stable and realistic and not wild and off market. The other thing we want is C1 differentiable and integratable. C1 compact support 1. What I mean by that is that we should be able to differentiate your interpolation function, and you should also be able to integrate it. Now, this is very specific for curve building because we need to pick a state variable, which we'll discuss later, and we typically want to select the forward rate and we need to calculate discount factors. And to be able to do so, we need to integrate our forward curve, which will be represented as an interpolation function, and so that our interpolator needs to support that, which we'll discuss shortly. Now, the choices of interpolation method that is quite popular, and I would recommend, are things like piecewise cubic Hermite interpolation. So what that means is we use a cubic spline piecewise, so over sections of the curve. And the reason why I say this particular one, cubic Hermite, is because it's very good for it's known for being locally stable. So it's quite a standard one to use. There's another flavor of splines, which is called tension splines, and they have a tension parameter which controls how linear or how smooth and curve-like you want your interpolation function to behave. There are many other choices, lots of good ones. These two are popular and they're pretty good. So I recommend these two. Now, the third thing that we're going to need, so we need instruments, interpolation methods, and the third thing we're going to need infrastructure-wise to build a curve, you need a multivariate solver. We could bootstrap our curves. Don't recommend that. We'll talk about it later. But when we're building and calibrating our curves, and when we're trying to solve for the forward rates and discount factors, we typically want to do that in all in one go, or solve all instruments at one go, and the multivariate solvers will do just that. Now, the type of algorithm that I personally like to use for multivariate solvers would be a gradient descent algorithm, and that's because it's using the slope to solve for our solution for our forward rates and discount factors. And these gradient descent algorithms, because they have the gradient which represents in a sense, our DVR1 or our first order risk, we can store that risk, that Jacobian, which is a derivative matrix, and that can be used for rebuilding curves in a very fast manner. It can also be used for analytical risk. So I strongly recommend the gradient descent, not because it sort of necessarily helps the solver process too much, but it provides a lot of great benefits when it comes to risk scenarios, fast curve building, and analytical portfolio risk. So it's going to be extremely helpful and give you an advanced curve. A basic sort of multivariate solver would be Newton-Raphson, and Newton-Raphson can, in some cases, break down and fail to solve. But because we're working with a nice smooth curve because we're using a cubic Hermite interpolation, you'll typically find that it will always solve and you won't encounter that issue. So that selecting the right components and putting them all together in a sensible way is going to avoid a lot of problems. So three things we need: instruments, swap and futures instruments, a good arbitrage-free interpolation method, and a multivariate solver, ideally one that has a gradient descent with a Jacobian derivative matrix. Now, if we talk through the calibration steps, so having all the infrastructure readily available, we have to pick a state variable. That's the first thing we have to do. But the state variable is the variable that you're solving for. So you take prices from the market of very liquid instruments and you want to solve for something, and that's the something you solve for. Now, I would strongly recommend that you always solve for forward rates and never solve for discount factors or zero rates. And the reason for that is point two. Point two is the functional form or the interpolation scheme. That's part of your calibration. You have to choose the dynamics and the shape of your forward rates. And it's very hard to control forward rates if you're not selecting them as your state variable, because discount factors and zero rates tend to give you very choppy and spiky forward rates, and they're arbitrage free. So working with anything other than forward rates will typically give you a curve, a yield curve that is not arbitrage free, and I strongly discourage you from using anything but forward rates. It creates a lot of problems, and sometimes people pick discount factors, try to do things like log linear, and you just end up with a yield curve that isn't as smooth as it needs to be for trading in the market. So please use forward rates. Other state variables may be easier to work with, but forward rates will give you the best possible curves and minimize arbitrage in the market. And then the third thing you need to do, so you select your state variable, select your functional form, the interpolation scheme, whether you want linear or cubic, whatever you want to choose, and then you solve or minimize. Now, minimize will mean you'll have some error in your curve. Solving is always a bit better. Now, one thing to sort of mention with the choice of interpolation scheme is that we really want that to be arbitrage free. So that's the primary thing that you should be thinking about here. How do I get my forward rates to be as stable as possible, as smooth as possible, and having the dynamics of the market? Now, there are potential issues with calibration that a lot of the recommendations I'm making to you will address. So the issues we're going to have. Interest rates are trade in electronic markets, so the big chunk, if not a majority of the market, is electronic trading. And so speed is a requirement. Accuracy is also a requirement, typically to 1/10 of a basis point, which is the bid offer spread. So you need to be more accurate. And therefore, minimizing and knowing that there's going to be errors on your curve is not a good idea. So you typically want to solve, and you want to solve for a higher precision than the bid offer spread, which is 1/10 of a basis point. Basis point is 1/100th of a percent. We also want risk and stability. And this was tying back to what I think is really important in step two. So when it comes to, it's not unusual to have two cuts for interest rates where we select a nice, smooth, spline-looking interpolation scheme for pricing to get the best possible prices. But then for risk, it's really important to have local risk. So it's not unusual for traders to select linear to sort of to enforce that all shocks and bumps and scenarios that they run on their yield curves have localized risk. And that's to reduce the amount of hedging you make, and it's just to really reduce the noise in your risk. Now, if you have a good interpolation scheme that is already local, you will only need one curve. But if for any reason your curve isn't smooth when it's bumped or shocked, if it's not so stable, then you can use linear for risk, and then cubic spline or smooth form a smooth interpolator for the pricing. So risk and stability can be achieved by selecting different schemes for different purposes. So maybe pricing, you want smooth curves, localized curves for risk. Now, if you do pick cubic Hermite as your interpolator with localized monotone implementation, you can just use the one curve and it will be local and smooth. But just giving you some tricks and tips in case you want to explore other things. Now, the other thing we're doing here is solving for all instruments at the same time. So internally in your code, you're going to have a matrix of forwards and discount factors. And if that matrix size is large, and if it's not positive semi-definite, you won't be able to invert your matrix. And if you look at the Newton Rafson sort of solver method, there's an inverse derivative in there, which is your Jacobian. And so if you're not able to invert your matrix, you won't be able to solve for a solution and your calibration routine will fail. So what you will find is if your functional form is smooth, if you'll find that your matrix will be positive, semi-definite, and if not, you will have to clean the eigenvalues and deal with that matrix to make sure it is invertible, which is tantamount to minimizing. Now, so we need to take care of our internal infrastructure to make sure our matrix is invertible. Now, it's very difficult to get a perfect curve shape. And what I mean by this is not necessarily perfect, but arbitrage-free curve shape, which is smooth. So very important to pick a good interpolation scheme to overcome that. Then we have to think about bootstrapping versus global optimization. Bootstrapping is a very old-fashioned way of building a curve. Sometimes people will do that perhaps just for the futures section of the curves, which are typically linear. But I would strongly recommend you work with global optimization, whereby we solve for all points at the same time, so that all any information that's shared between instruments will be taken into account. So global optimization, always recommend that rather than bootstrapping. The other thing you have to think about as well, spline routines being piecewise constant typically need to be solved in one go. So you can't typically bootstrap using a spline. So bootstrapping does restrict you to perhaps linear interpolation, which is not ideal for our needs. So please use global optimization where possible. Now, we need to talk about the overnight index rate. So in our US dollar curve, and typically in many of the new risk-free curves, there'll be an underlying index. And I'm looking at the US dollar one, which is the SOFR rate, just so you can understand the short end nature of the curve and how it behaves. So typically on the short end of the curve, between central bank meeting dates, for example, in the US, this will be the Fed meeting dates, you'll find the curve is typically flat. Now, it's not perfectly flat, but many practitioners will model the curve as being flat. And then you'll have jumps on meeting dates where the interest rates are cut or increased, and you'll see a gap down. So you'll see these jumps, and then followed by another period of linear and a jump, and so on. So you find sort of piecewise constant or flat between central bank meeting dates, such as the Fed meeting dates, followed by on decision dates, you'll see a jump down or a jump up, depending on what the policy decisions were. Now, on top of that, you're going to sort of see liquidity squeezes and spikes. So if there's a squeeze in the market or a lot of demand in a particular day, you'll see sort of spikes up and sometimes spikes down. And when funds are rebalancing their portfolios, you'll see a lot of demand for you see a lot of activity in the market when the hedge funds are rebalancing their portfolios on quarter ends and year ends, and then these jumps will be pretty large on those dates. And so advanced curves need to take care of these features. So I just want to show you what the behavior of the underlying in benchmarks sort of behind these yield curves. These are the interest rates that we're trying to forecast and the discount factors from these in benchmarks as well. That's the whole point of the yield curve. So I'm showing you the underlying behavior of the benchmark index, sort of that the yield curve is looking to imply forward rates and discount factors for. So the underlying index behaves like this. Now, advanced features that yield curves need to support. So we have to bear in mind interest rate markets are typically electronic, so the curves need to tick away in real time. Quite often, curves need to be built a very sort of just to get by. A modest curve will be working in milliseconds, but we really need them to be working in nanoseconds. Curves need to support auto execution and sometimes auto hedging. So these curves need to be ticking away to give you real-time pricing. Now, for this real-time pricing, we typically going to need a Jacobian for fast rebuilds and also for analytical risk. So to be able to get our curves to be working really fast, we can use the derivative matrix, which I'll explain shortly, and we use that for analytical risk. So the derivative matrix is basically telling us what's the change in the price of the calibration instrument for a change in forward rates or discount factor, depending on your state variable. I always say if you pick forward rates as your state variable, you're going to get the change in the par rates of your swaps for a change in forward rates, and you can use that directly then for DV01 calculations. Now, that risk matrix is also telling us how does our curve change with market data. And so how do forwards change in market data? So if you want to build your curves really fast, what you can do is you store your original curve based on the current market data. You track changes in the market. You multiply those changes by the by the Jacobian or the risk matrix, that tells you then how the forwards have changed, add them together, and you got a new curve. And that simple process of measuring market data changes, multiplying that by the known derivative matrix or Jacobian, that's a very fast operation, and it can even be parallelized and threaded. So that can be done in real time, whereas calibrating and solving for all instruments on a curve takes a little bit longer. So this Jacobian approach gives you the possibility to have a very fast curve rebuild, and it can also be used in conjunction with the risk vector that comes from the trade to have real-time analytical risk. And that's not just the total risk, that's actually the bucketed risk telling you where to hedge. And that can be done for your entire portfolio in real time. So it's a very advanced, exciting sort of feature to have when you have this Jacobian, which will only be available if you have a gradient descent solving algorithm. Now, the other thing we need to have in advanced curves, you need to have the ability to sort of incorporate jumps. Jumps and those spikes are typically managed by having an overlay curve with those spikes manually added on top of them, and you add the overlay curve to your regular to your existing yield curve, but you have to do it as part of the calibration process so that these jumps are incorporated into your pricing correctly. So that you have the forward rates that incorporate these jumps. Now, these overlay curves, these jumps, they're typically the biggest ones you need to manage as the turn of year effect. So typically towards the end of the year when funds are rebalancing portfolios, you'll see a big spike in the benchmark rates, and those need to be managed well. Pricing will be quite off if you don't take care of that on year end. Now, the other thing we also need is advanced hybrid mixed interpolation schemes. And now, what do I mean by that? So that's an advanced feature. You're typically going to find, and I'll show you the diagram shortly, that on the short end of the curve, we need to sort of between meeting dates, we want the curve to be flat, we want to have jumps, and we want to have futures section being linear, because that's how the dynamics of the futures instruments. And then on the longer end, we want smooth swaps. Now, one interpolation method isn't going to handle that. But what we want to sort of say is we want our interpolator to manage these different features. So when you get to the end of your central bank swaps, around the swaps that are trading on central bank dates, you want those to behave flat, you want futures to behave linear, and you want to have your swaps smooth. And this interpolator, and we can set up interpolators so that you give it the joining points between each of these different instrument sets, futures swaps and the central bank swaps, and it will just automatically switch to being flat, linear, and smooth, sort of spline looking. So that should it's always best if you can manage that in the interpolator, and then have a smoothing function that takes care of the joining points so that there's no kinks and arbitrage points. Now, one of the very advanced features of yield curves as well is that we also need yield curves for cross-currency swaps that incorporate collateral being posted in different currencies. And that's what the CSA or the cross-currency curves are doing. And in those curves, we don't calibrate to the regular interest rate swaps. We calibrate to cross-currency swaps and perhaps FX instruments as well. And these curves, an advanced curve for cross-currency would also incorporate cheapest to deliver curves, whereby you could have a collateral switch where your instrument is perhaps part of a bigger set of instruments you want to price, and there's the possibility to switch collateral to the cheapest, and yield curves then would also need to incorporate this cheapest to deliver collateral posting, which is a little bit more complex than the CSA adjusted curve for cross-currency. Now, finally, some of the other advanced features that traders like to sort of see is that they like to sort of perform PCA analysis on the yield curves to sort of predict which way the curves are potentially moving, but also to smoothen out their curves and sort of hedge the principal components. And the other thing that also it's quite a common thing to see is support vector machines, where they're using machine learning classifiers to determine whether they think the curve is rich or cheap. So these are some of the advanced features that we want to involve in our yield curves, to work in electronic markets. Now, on basic versus advanced curves, if you were to just build a curve, perhaps just from swap instruments, you would typically get a smooth line like the dotted line, what we see here. If we were then to incorporate all the different features and the different instruments, so for example, between monetary policy meeting, between central bank meeting dates, we would have, there are swaps that just trade the single period over the starting on a central bank date and ending on the next one. And those swaps are MPC swaps or Fed fund swaps, FOMC swaps. Those in the US markets, those would be flat, as we discussed, and they have some jumps. It's a little bit exaggerated here, just so you can see what these might look like. So we want our interpolation scheme to be a mixed interpolation scheme, whereby we can incorporate these jumps and these turns. So we see it's flat between meeting dates. We might have some jumps, and these jumps are sort of managed by the traders. They will actually put them on manually, and they will adjust the heights and make them fit the market. It is typically a manual process. It can be automated as well, but traders like to watch that quite closely. So the front end of the curve, we want to behave like this. The futures instruments in pink, they're linear. There's a key here. So we've got piecewise constant for the monetary policy swaps. We've got linear for the futures, which are in pink. And then the SOFR swaps, and sometimes tenor basis swaps, we want to have a nice smooth spline. And you can sort of see that the curve shape is different. The choice of calibration instruments does change your curve, even with a basic curve when you're picking futures. Even then, when you're selecting the basic instruments, you can have differences. So it's very much an art in terms of where you think the market is. It's not unusual to have many curves. So have one set of curves for short traders trading on the short end of the curve and have another set of curves for traders working on the long end of the curve. And then they would pick more instruments to suit where they're trading on which whether they're trading on the short, medium, or long end of the curve. That's also not unusual. But it's also good to have a single curve that you can use throughout the bank for everything, just for consistency, so you don't have arbitrages between different desks. But it's not unusual to internally to have multiple curves, just to sort of help you sort of understand the dynamics of the section of the curve you're trading. Now, the Jacobian is something you definitely want so you can manage risk scenarios and also to calculate EV1, bucketed EV1 in real time. The Jacobian, the derivative matrix, will support fast rebuilds, which you mentioned. It'll also, our advanced curves need to support electronic markets, so we need very fast rebuilds just because the market's ticking in real time, and we need to support that. Millisecond calibration is kind of bare minimum just to get by. And nanoseconds, you need to work in nanoseconds if you want to sort of work, if you want to trade on exchange. And that's nanoseconds for the risk as well. So we really do need analytical bucketed portfolio risk to sort of manage your, to track your portfolio positions in real time. Now, obviously, if you're not trading, if you don't have a large book or your time horizon for your trades is a lot shorter, you're not sort of trading in and out in a day. Yes, you could, of course, have a slower curve. There's nothing wrong with that. But to work in electronic markets, you really do need to work with at least a millisecond calibration of your yield curve. Now, why is it so hard to set up if you haven't already guessed? So we typically want to sort of calibrate multiple curves at a time. Some of them have codependencies, and we might need to incorporate those. We're typically calibrating over 100 instruments in real time simultaneously. We're quite often we needing to know the 3-month points pretty much always on all curves. So we have a lot of forecasted points to solve for. So it's not unusual to have more than 10,000 points and discount factors too. We need to be able to price a wide variety of instruments, calibration instruments as well. It's not unusual to have a mixture of the old LIBOR curves and some of the ARR curves. That's the alternative reference curves, which we now call the risk-free rate curves, like SOFR and ESSA. Asian markets are still very much using LIBOR curves. They're still in use, not so much they're not used in US and Western markets. And this complicates the setup. This mixture of LIBOR and risk-free curves or ARR curves does complicate cross-currency swap trading and cross-currency curves. LIBOR curves are typically forward-looking, so you set the rate today for the next 3 months or next period. Risk-free curves tend to be backward-looking, which means you don't know your rate till the end of the period, so they have different behaviors. Convexity adjustments of the futures, when you're working with the risk-free curves, you might be sort of part way through a future, and because your interest rates are being set daily and then averaged into a rate for your period or your term rate, you will need fixing tables to measure which 1-day rates are in the past and you forecast the 1-day rates in the future. Maybe this is over a 1-year period. You take the average, and that's your effective rate. But you, for the front futures contract, which is from the 3-month futures and the 1-month futures, you may have part of the futures in the past, and so you need to keep fixing tables. And those fixing tables, that data needs to be incorporated into the convexity adjustment. The convexity adjustment, loosely speaking, is the difference between a FRA with no mark-to-market adjustment, which is because it's off exchange, and the futures contract, which is on exchange with a mark-to-market adjustment. So, loosely speaking, convexity adjustments are going to be the difference between the futures price and the FRA price. And so fixing tables are needed to capture some of that, to capture some of this convexity adjustment calculation. Now, I do strongly recommend hybrid mixed interpolation types, mixed interpolation methods with jumps and turns, and that's so that we can support this curve. So we could have one interpolator, which is what I have, where we have flat rates here with jumps, linear in this section, smooth in this section. I specify the joining points, which is the end of each of the instrument sets and the start of this. So one at the end of the MPC swap, start of the futures, and another joining point here. And the interpolation method will then know to use jumps and piecewise constant here, piecewise linear in this section, and then smooth spline, cubic Hermite spline on the long end. And all whilst keeping everything arbitrage free. So the interpolation schemes are highly important. That's going to drive the dynamics of your yield curve. Instruments have to reprice to 1/10 of a basis point, which is the bid-offer spread. That's how many zeros: 1, 2, 3, 4, 5, 6 decimal places here. So we need a lot of accuracy, 1/10 of a basis point being 1/10 of 100th of a percent. We need our curves to, at a minimum, sort of calibrate within 5 to 10 milliseconds for modest performance and ideally nanoseconds. And we need risk sensitivities to be also be captured so we can calculate risk in real time. So it's very difficult to get all of this working. It's not unusual for it to take 1 year or more, or maybe even 2 years to set up all the different instruments, all the different components that you need. If you already have those basic components, obviously you have a massive head start, which is great. Now, I've written a book that's on low latency interest rate markets. It really does take you through how to set up quant libraries and all the and it's got quite a large section on yield curves. The book's called Low Latency Interest Rate Markets, and you can get an overview of the book here on this link. And if you want to have more details on quant finance and yield curves and interest rate products, please subscribe to my YouTube channel. Thank you very much for your time. Thank you. Bye.